In this video, I want to go over SPX versus SPY options versus the S&P 500 E-mini or micro E-mini future contracts. I want to show you examples of when it's best to trade options versus when it's best to trade futures. I want to get into trades that I took, why I took the futures, why I took the options, and I want to break down some important points that will help you make better trading decisions. Before we get into it, I recommend everybody watching this video to stop what you're doing and follow me on my Instagram. The link will be in the description below. This is my only account. It's a very good resource where I post daily trading recaps and really good trading tips and tricks that I guarantee you're not going to find anywhere else. The link is in the description below. You're missing out if you're not following it. A lot of people always ask me, Carmine, should I trade options now or should I test out futures and see if I like them better? Well, this is going to guide you in that right direction because what I do is based off these points. So if you trade SPY or SPX options, and this could relate even to NASDAQ, oil, gold, or any other option to begin with, you want to make sure the most important factor for me for when I trade options is there volatility and is there clear direction? If I see volatility and I see clear direction, I will favor trading options over futures. Why is this? Well, options are priced because of, or a part of their pricing is because of volatility, and this will lead into large percent gains. However, with a large reward becomes even larger of a risk. This risk is you have to be correct trading options, not only on the direction, meaning I think that the market is going to come up. Well, if you can get the direction correct, but you cannot get the time frame that it happens in, then trading options are going to be harder. With options, you got to be correct on the direction and time. Time is a very important aspect along with volatility. So there's a lot of factors that influence options, whereas futures not as much. Options are much harder to manage risk because they are a highly leveraged derivative with a lot of external factors influencing the price. There's not much wiggle room and you gotta be correct fast. Not a lot of people are even correct on the direction, so what makes you think that you're going to be correct on the time frame that it happens in? You got to be fast and you can't give it enough breathing room, and the pullbacks are much deeper trading options. This is going to make sense when I compare both the options versus the futures. But futures are easier to manage your risk. 1 point on the ES futures is $50 per contract, and 1 point on the micro E-mini contracts is $5. So if you buy at 4,000 and your stop loss is at 3,990, 10 points away, you know exactly 10 points how much you're going to lose. $500 trading one E-mini contract and $50 trading one micro E-mini contract. 10 points is $5 or $50. With futures, you only got to be correct on the direction. I don't care if it happens now. I don't care if it happens 3 hours from now. Time is not a major issue with futures. Futures do not get priced because of time. Options, a large portion of how it gets priced out is based on time, whereas futures, it's true organic price action, and you could give the trade more room to breathe because time is not an issue. Trading futures, in my opinion, is best for beginners once you understand the risks to margin, and it's better for consistency, building your edge, and defining your system. I recommend futures for all beginner traders once you understand the risks to margin trading. So now let's compare the two. And to the left of my screen is SPX. And to be honest, I classify SPX and SPY to be the same thing. They're options. SPX is more volatile, they are more expensive, and they move faster. SPY is cheaper and doesn't move as fast. However, to the left, we have SPX at the money options. And also, I do want to say, if you trade SPY, if you trade SPX, if you trade ES, or even MES, do all your analysis on the ES chart or the futures chart. What I would do is I would do all analysis on the futures chart. And if you trade options, simply go play at the money or one out of the money options based off of this chart. There's no reason to convert levels. There's no reason to translate levels. So here's SPX at the money contracts, and let's just say we enter at this oval right over here at 4142. This is actually a trade that I took. In the Discord, I post intraday commentary, updating my thoughts throughout the day of what I'm watching, why I'm watching it, and the market came right into my 4142 level on the E-mini future contracts chart, right into 4142. We found very strong buying, and I took a stab long at 4144 on the future contracts. For this video's sake, let's compare the two. So let's say I traded SPX calls instead of the futures. My entry was at $6.20. One contract would have costed me $620. Versus if I traded ES, one contract, depending on your broker and depending on the margin requirements, could be as little as $500 per contract. So a lot of people see ES or see the futures charts, they see it's trading at 4,000 and they think it costs them $4,000 to open up one contract. Well, futures are highly leveraged. You trade them on margin and the broker puts up the rest. Some brokers only need you to put up $500 or $50. So they're highly leveraged, and the price that you see is not the price of how much it costs you. In this example, this 4144 entry only costed me $500 to open up that position out of my own money. Well, now guess what? The market pulls back, and going over SPX down here, we sell off, and now my contracts are at $3.40. I'm at a 54% loss. We sold off, and after I entered, I'm down 54%. Now, it's kind of the same with the futures. However, it's easier to manage your risk, and it's not like that percent-wise. Yes, we broke the low, and yes, I'm down 6 points, and 6 points, $50 per contract is $300. And you're looking at it that, okay, I'm down $300 on an investment that cost me only $500. Well, that's not true. Only $500 out of my own money came out of my account, and the broker put up the rest. So your risk and the percent-wise of this trade is so much smaller trading the futures versus the options. Hypothetically speaking, let's just act like we did not stop out at the low for a 54% loss. And let's just say we kept holding now the future contracts into my target, which was the supply zone above. That is a 4144 entry to a 4159 target. That's about 15 points. And I think that's about a $750 to $800 profit on technically a $500 investment. Whereas the options went from a $6.20 entry to a high of about $9, and that's about 50% as well. However, the most important thing to highlight here is I have the crosshairs synchronized on the chart. If we were to look at the options chart broke below the low, whereas the futures chart never broke below the low. What this tells me is the premiums on the options are decaying because of time, whereas the futures, this does not matter. Also, because of how options are influenced by volume, once there's a large move coming into the market and a lot of people chase it, so let's just see they say the market coming up, they're late to the party, their entry gets delayed. Now I enter at $8. Well, 5 minutes later or 10 minutes later, the market dumps, and my entry at $8 is now down to $4. And in 15 minutes, I just lost essentially like 50 or 60% of my position very, very fast. Whereas if I were to trade futures, I know exactly how much I'm going to lose. I know where it's going to happen, and I can manage my risk properly. Whereas options, it's very difficult to put a stop loss because you don't know what the premiums are going to be trading at. Versus when there's volatility and clear direction, I favor trading SPY or SPX options. Let's go over this example today. And to the right, we have the E-mini S&P 500 futures chart. And let's pull up the pre-market plan. Again, I post these every single day in the Discord of setups I'm watching, levels I'm looking out for, and potential trading scenarios. Scenario number 1 was the bullish one. And keep in mind on 4175, 4180, which are these blue lines over here. If we can get above this with strong buying, strong volume, I want to play the market long, targeting 4193 to 4,200 supply, which is this red line right up here. Now, in the first 3 minutes on the S&P 500, it's very apparent that there's volatility. There's nice, thick green candles. There's nice volume coming into the market. If you're watching the time and sales in level 2, it was very apparent that there was volatility and clear direction coming above my levels. So in an example like this, if you really feel like it, trading options would not be a bad choice at all. We got direction, and the volatility is also going to help the time aspect of trading options. So what I would do is I would go to the options chain, I would type in SPX, simply watching the ES chart, I would pick at the money contracts, and I would paste them into my chart. Now to the left, we have the SPX 4190 calls, and to the right, we have ES future contracts. Well, if we were to get long SPX calls above, let's just say 4180, this was around $5. So 10 contracts would have costed us about $5,000. And around 4180, 10 contracts of the E-minis would have also costed us about $5,000 of our own money. So our SPX calls from our $5 entry to, let's just call it the supply zone target on the ES, was about $7.67. That's a 50% return in about 20 minutes. Really good. Our $5,000 investment just turned into close to $8,000. Whereas $5,000 of our own money on the futures went to a high of around 4193. That's a 13-point difference. $50 times 10 contracts is $500 per point times 13. That's about a $6,500 profit on a $5,000 investment. So from a technical percent, which it's very hard to do with options, it's a safer route. But then later on in the day, let's just say we didn't sell that supply. This thing kept going up. The volatility is increasing. Look at the volume on the options. Look at the volume on the futures. Our $5 investment now going up to $18. And our $5,000 investment now is up 262%, and $5,000 just turned into $18,000. Obviously, this is from low to high. It's a perfect world. But when there's volatility, the options become more favorable. However, as a beginner trader, if you are developing your edge, these volatile days, these clear direction days where it's perfect, we straight up, straight down, are few and far. They're not very frequent, and it's not like we get them every day. So for a beginner trader, and you're looking to build your edge, and you're trying to figure out which one to trade, in my honest opinion, it's best to trade the future contracts, specifically the micro E-minis, because they are a 10th of the regular E-mini contracts. It's better for consistency. It gives your trade more room to breathe. It's true organic price action, and you don't got to worry about time. You only got to really care about direction, that if you buy at 100, you want to be selling it higher than 100. Like in this example, here the S&P broke the low on the options, but on the futures, we never broke this low and we were much higher. Or we got that rally up, and look at that rally up. It's about $19 on the option contracts. If you got long at 15, at 16, at 17, right? As we were coming up, those got dumped on and they went to a low of around $4, whereas we sold off close to this previous low right here. Whereas this sell-off over here never even came close to this low or this low, and the options got deflated very fast because of the lack of volatility and the lack of direction as we get closer to end of day. So check out some other futures trading videos on my YouTube. There's a full futures section in the course. There's a more in-depth video actually on this in the course. And I seriously recommend, if I were to look back and if I had to start over, I would start with the micro E-mini future contracts and build my edge off of that and forget trading options. Because once you have your edge on the S&P 500, it's easier then to trade options. But it's harder to build an edge and a foundation with options, in my honest opinion. You might agree with it, you might disagree with it, but that's the market and that's how it goes. So I'm going to end it on that note. If you enjoyed, drop a like, comment any questions, and definitely check out the links in the description below. But I'm ending it. Peace.